Hello. There are two things I'd like to touch on today and how these factors are affecting the portfolio shifts we've made last week and what we'll be making in the near future. The first point we'll touch on is the election results from last week and how the market tends to react after a midterm election. The second point we'll cover is how the new inflation data we're seeing could affect the Fed's rate hike decisions moving forward. First, the midterm election. Historically, there are two key takeaways from midterms. One, markets like them to be over. Two, markets prefer mixed government, aka gridlock. The first one is just a matter of time passing. The second item, gridlock, looks like it's the most likely scenario at this point. Markets have historically done well in the year after midterms. In fact, since 1950, they've been higher 18 out of 18 times the year following a midterm election. Now, there's no guarantee that's going to happen this time around, but still, when it comes to mixed government and markets, the trend has been consistently positive for 70 years. So what does that mean from a portfolio perspective? Last week, we decreased bond exposure and hedged alternatives and increased our stock allocation. Now, on to inflation. After many months of inflation coming in above expectations, investors finally got a more favorable report from the October Consumer Price Index data, and we're cheering it with a big stock market rally last Thursday. Both core and headline inflation rose less than forecasted, pushing the annual rates down considerably from the previous month. In October, the annual headline inflation rate eased to 7.7% from 8.2% in September. The economy is still finding its balance after multiple supply shocks from a pandemic and a war in Ukraine, but we may soon see a more broad-based deceleration of consumer prices. Headline inflation is likely past its peak, but the Fed still has work to do. The easing inflation measures give the Fed some leeway as it begins to downshift from the recent aggressive pace of rate hikes. As policymakers have publicly indicated, inflation is the primary concern. For now, the Fed is willing to sacrifice the economic growth in the near term to get inflation back to the long run rate of 2%. But in the near term, investors should respond favorably to these encouraging moves. So what does that mean from a portfolio adjustment moving forward? As the Fed slows their future rate hike path, we'll begin deploying cash into opportunities we find at a favorable price. This means increasing stock exposure by deploying cash as additional information comes to light. In conclusion, we expect the impact of elections to tilt the market positive, partly because we'll have it behind us, and also because markets tend to favor mixed government. However, moving ahead, market participants will be more focused on central bank policy and inflation. We do see a strong possibility that inflation will continue its downward trajectory. If you have any questions, feel free to reach out. And as always, thanks for watching.
Thanks for watching this video. If you liked what you saw and found it helpful, we'd really appreciate it if you could subscribe to our channel and hit the bell for future updates and financial education. If you're interested in learning more, or if you'd like to partner with our team to simplify your life through financial clarity, call or message us, or visit our website that's linked in the description. We hope you have a blessed day, and thanks for tuning in.